Welcome to AM Best Audio.
I'm William Borden for AM Best Audio. I spoke with Sabine VanderLinden, an Insurtech luminary and founder and venture partner for Alchemy Crew. We spoke about how insurers can bring Insurtech and AI into their operations and where there are the pitfalls in bringing transformational technology to the industry.
So when you look at Alchemy Crew, right, which I created and co-founded in June 2020, project in maturity probably slightly earlier, so just in the depth of COVID-19, the goal was to position the company as a venture client builder, venture client bridge for risk incumbents. Rather than just taking equity stake, which I learned to do when I build acceleration programs such as Startup Bootcamp, we aim to scout and validate startups. Then we orchestrate what I would say a 90 days preferably, but it can be up to 120-day pilot program that let carriers buy out, I would say, outcomes, not ownership. And this is important. What we've seen is a lot of insurance corporates have not been that successful in investing in startups. Not everybody knows how to do it very well. And usually when you work with B2B startups, scale-ups, it's better for a corporate to become their first customer. So to facilitate that, I developed a framework. When you start refining and working with a lot of corporates, you define your own framework, and I call mine DIVA with 3 A's, which stands for discover, investigate, validate, adopt, activate, and amplify. For me, it's a balance between doing the work behind the scene and also talking about it and promoting it. So it's why we have always so much content on our website around the work we are doing. We tend to source a lot of solutions through databases. So we have our own 4.5 million startup, and the goal is to de-risk engagement and then to scale the work with the corporate. So one statement you must have read about me, I hope, is why build when you can partner? And I try to remain true to that statement. So I've done great work with a lot of corporates. Very proud of the work I've done with Zurich and Ergo over the years. Now, I'm working with even CVCs with their AI transformation mandates, from dynamic underwriting to AI-led litigation management. The key is to really understand how we can help corporates identify the new opportunities, what I call the Horizon 2 and 3 opportunities to actually drive competitive advantage and uniqueness. And today it's all about artificial intelligence. So we don't incubate ideas. We have to operationalize revenue, relevant solution, and then help insurers underwrite those.
So on a certain level, it's almost like giving the big corporate partner an opportunity to kick the tires on a particular technology with a partner, just to give it a trial run to see if there's value to be derived, I guess.
Absolutely, 100%. What you find is often corporates, have a lot of ideas, also use a lot of technology, but by doing it in a very strategic manner, based on a mandate, I call that a mandate, where we align the strategy with operationalization, we understanding where the market is going, then we can identify really the right solutions. And I don't just stick to Insurtech. For me, is technology for insurance, or I may talk to AI ventures as much as cybersecurity venture or AI infrastructure ventures, healthcare ventures, right? It's about solving the problem with the right venture, and it's about really understanding very well our industry, but also understanding very well the mandate, so that we can actually go and hunt for the solution which will be the right one for the corporate. And in some ways, we apply very similar technique to the VC world, right? The way they go and identify ventures for them to invest in, we select and apply very similar method within the venture client world.
So you had mentioned health within the mix as far as looking for solutions there. what sort of needs do insurers have when it comes to these tech partnerships compared with other sectors, such as your typical fintechs that are dealing with banking or securities trading?
Yeah, for me, I think there are three main ones. So I think first is about a different business model and the fact that, insurance is very liability focused. I mean, there was a piece of research I read from Bipartisan Policy Center, which explained that insurance and banks are fundamentally different industry for them. And I would agree somewhat as well. Each has distinct business models, meaning that, they have different risk profiles and regulatory regimes they have to actually align to. Insurers promise to cover future losses and pool risk over a long period of time, whereas banks transform short-term deposit into loans. This is true, but also when you start looking at life insurance, for example, they invest in long-term assets, whilst P&C insurers match asset to the duration of the policy. So, we have long-tail liability lasting years or decades. The other point will be around distribution and regulation. Mm-hmm. I think insurers rely on licensed agents and brokers to sell products. Their policy forms and the rates must be approved by state regulation in the United States. Banks, by contracts, probably use branches and do not license individual employees to sell deposits, right? So this complicates data sharing, compliance, and modernization, I think, within the insurance space. Also, insurers also file products and models with regulators, maintaining loss reserves, manage reinsurance, and deal with claims and fraud, which often doesn't align or mirror with banking and security trading. And lastly is around the tech partnership. We mentioned fintech. Because insurers operate under state-based oversight in the United States, and we have a lot of regulations in Europe as well, just right now, insurers have tens of regulations to contend with. Then that has an impact on long-term liability. Insurers need technologies that offer explainability, actuarial soundness, and audit trails. So, for example, I was analyzing Wacom and the way Wacom has built its digital ecosystem, and they have to embed that explainability, actuarial soundness, and audit trail in every piece of technology they are putting to market. Further, I think partnership must handle underwriting authority, regulatory filings, agent and brokers incentives as well. Banks, on the other hand, might pilot a new payment hub. Insurers might validate those models and ensure that remain compliant, whilst public banking have probably lighter demand on them. So I think for me the implication is that technology is not enough often in our industry. You need line of business fit, explainability, and change management, a lot of change management to actually make sure that insurance companies can be innovative and at the same time fulfill the compliance and regulatory requirements which are completely surrounding them.
And I guess you mentioned the adapting to change. I guess there's a bit of cultural buy-in that you need from your employees. Can you give a little bit more insight about that?
Yes, change management, buying from the employees. As we know, there was a recent piece of research from MIT and HBR in recent weeks, which stated that 95% of pilots fail within corporations, and that is all corporations, not just insurance companies. And the thesis behind this analysis is still, when you start looking at artificial intelligence, those projects are very technology focused. Now, with the speed at which we have to embrace AI technology, organization needs to not only to see how they can bring employees on board with that transformation, upskilling and reskilling talent is really critical, but it's also about making sure we have the right type of leadership and we have the right type of culture internally for this to succeed. So the 5%, which has literally projects which succeed, Yeah, technology is part of the equation, but what is more important, they have realized, is leadership culture. So therefore, change management, but also is upskilling and reskilling the employee within the organization.
I think it's kind of interesting. Employees can be a very cynical lot. And when you have what almost seems to be serial tech implementations, how does that sort of jadedness and cynicism set in to a culture to say, oh, here comes the tech guys foisting something new on us this year again? And how do you try to overcome that as a company that's looking to generate some sort of buy-in?
Not easy. I would say it's definitely not easy. What I've seen within organizations which have been able to do that well is that they implemented either an ambidextrous strategy, so one strategy which is about run the business, so business as usual, and then this strategy of innovation where they have champions, where they have people really educating the rest of the organization on why technology adopting new technology is critical to ensure that the business remain unique, differentiated, and actually can drive competitive advantage for their customer. At the end of the day, we are all aspiring for this Amazon-like experience. Our customers are expecting that unique customer experience, and we need to make sure our business align to that. And in insurance, because it's a risk-averse industry, we all tend to be most of the time behind. And so what I've seen, that hybrid ambidextrous type strategy tend to work for the avant-garde, right, the early adopters, because they find a way to create the right balance between fast innovation and transformation alongside running the business and making sure we serve the customers that need to be served day to day.
When I speak to some executives, they tend to be fast followers. Like they'll let somebody else break the ice as far as the new technology, and then they kind of hope to learn from other people's mistakes. Yeah. So they're not causing too many problems for their employees, or they I guess that's part of that risk averse element in insurance culture. Can there be a situation where those rapid adopters kind of build an insurmountable lead, or is there still room for companies to kind of leapfrog by maybe pausing and saying, well, let's see how far they go out on the limb here?
Yeah, it's an interesting question. So when I talk to insurers, we always talk about the defensive versus the offensive strategies. I think they should be used as lead and lag approaches, actually. Lead on areas such as company has proprietary data, amazing brand, and as also amazing distribution channel, right? When you think about specialty lines, climate resilience, ESG, those are critical because first movers actually are able to accumulate data advantage that compound over time. I remember reading a piece of BCG research showing that only 7% of insurers have scaled AI successfully, yet those that invest early and foster culture of change, as we just talked about, achieve productivity gains of over 30%. Now, when you start looking at the second strategy, adopt off-the-shelf tools, so that will be more the one who wait and see and then try to play catch up. That would be for me within the sphere of office automation, augmenting employee, generating chatbots, for example. When the market matures though and price falls, then everybody will play catch up. Everybody will have access to this technology. So I think insurers there needs to be wary of technology leapfrogging that force disparate investment. Emphasizing value-driven experiment and kill switches. Again, another piece of research which might be relevant here is PwC, which actually report that partnership and ecosystem with AI can embedded seamlessly across the insurance process can actually help organizations do better, partly when you start looking at distribution or competing against embedded players.
How much of an impact do you see AI having on the more back office areas such as human resources, legal and compliance, finance, marketing, all those functional areas that you need to do just to make sure that you're competitive and getting things done the right way, so you're not running afoul of regulators, I guess?
Yeah, I mean, so AI is going to impact the whole insurance operation, so there's no doubt. When we looked at the insurance, what I call the insurance box, right, the different operating environments, right now I would say, a lot of excitement around underwriting and claims, there is no doubt. Where we have seen a lot of benefits, right, is marketing and sales, because you do not have to put insurance or clients' data. You can actually use what we call synthetic profiling. So you create a synthetic profile of your target market, and then you can actually start seeing how that market is going to respond to a marketing campaign or sales campaign. Another area where I think we have seen less technology, but I think it's going to ramp up, is the office of the CFO, legal risk management. Now, to come back to your questions with regards to back office, I remember 2 years ago working on a piece of work, a mandate with IBM. Mm-hmm. And we were looking at generative AI with IBM Orchestrate. IBM with IBM Orchestrate was able to reduce their HR team from 1,000 to 30 people.
Whoa.
So that is the impact generative AI or AI can have on the HR office, right? Talent screening and upskilling, you can use the technology to do that. Legal and compliance, you can see policy drafting aids, clause comparison happening. Finance, anomaly detection, faster closings being undertaken. So I would say, when you start looking at those back office areas where there's a lot of documentation, actually AI is going to have massive impact. And I can just say, if you have some time, go and check the IBM HR case study, because that is one which has been read a lot. And, I've made people upset, but also that is the reality of things.
But,
you end up focusing on the job and then giving complex tasks to your team and letting more mundane tasks, repetitive tasks being handled by technology.
Customize your data experience. BestLink now offers an interactive company dashboard that provides company-level intelligence in a fast, user-friendly interface featuring interactive tables, charts, and Sparkline performance histories. Customize the dashboard tiles to prioritize the insurer ratings, data, and analytics that best support your workflow. AM Best. Our insight, your advantage.
Yeah, I on a certain level, you talk about those kind of job losses. I mean, it also reduces a lot of barriers to entry for certain businesses, and it kind of allows greater competition if you find your right niches and can replicate certain. I guess it's easy to plagiarize certain business models. That's what I'm getting at here, and technology makes it very possible to do so. So,
you can build a website in minutes now, Bill. You can build a website in minutes. You can ask AI to say, I like this website, please replicate it for me for this target audience. It's possible. And then you end up refining the proof points and refining the copy in a way which is much more authentic, but you don't have to start things from scratch. And a lot of, macro businesses or solopreneurs are doing well in the age of AI.
Yeah, and I know there's a lot of capital out there that wants to go into the insurance business. It's almost like you could set up the storefronts pretty quickly, and if you have the capital behind you, it's just get your license to sell on a certain domicile, and you're hang a shingle on the door. So it should. I think on a certain level, it's just going to be a much more dynamic sector than what people are accustomed to.
I think you have that fear, right, because of the unknown. And you mentioned the fact that some people talk about job replacement. Like, any industrial revolution, I think there's going to be a shift. But we have the opportunity to adapt, to learn, to continuously educate. During the weekend, Bill, I will go and try vibe coding and understanding what vibe coding is, which is literally learning as a business person how to build an app or build a product using tools where I just have to put human, language, the way I communicate to produce something. I will also go and play with ChatGPT, Perplexity, Code. I will compare the product output coming from the different platform. I will go and try to build my own agent. Say, okay, we are talking about agentic AI. What does that really mean? I go and play with the technology to understand what an agent might look like and what that might be for my business. I'm educating myself because I want the executive I interact with to understand that if I'm able to do it, at my age, they are able to do it as well. And I'm not young, Bill, just so that you know, I'm not that young. I've been in the industry for 28 years. So what I'm trying to say is executives should be able to do that themselves as well. So then it's a willingness to try. And then everybody should not feel that they could be replaced if one individual with AI comes together. We have more power to define our future than if we didn't use the technology.
So it's a matter of augmentation rather than replacement.
For me, it's all about augmentation.
If you're willing to build your skills in that field.
Absolutely. And I don't think it's an if, though, Bill. I think we have to be curious to really understand how this is going to impact us. AI is going to be on my mobile phone. AI is on our laptop, on our iPad. So it's already there in the device we use every day, right? It is in your PPT on Microsoft. It is into your Copilot. So it's not an if. I think it's a when. And again, early adopter, fast followers, right? The early adopters are going to be the one who are going to have an edge on the others. So all of us, we just need to be mindful of that.
You've mentioned the different vehicles for AI to reach people. I mean, now you have this notion of, eyeglasses and other Internet of Things that can be pulled in to draw information for, whether it's data gathering or helping to adjust particular appliances that you might be wearing on your body or on. So on a certain level, I guess you're looking at how these devices work with third-party data and manage to incorporate them, whether it's adjusting a medical treatment in your own body or working out something as far as measuring risk and weather.
100%. I mean, you mentioned IoT, right? IoT sensors collect behavioral data. I have my iWatch right here, which should be on my wrist, but it's a bit warm, so I took it off. But when you start looking at this technology, it's collect behavioral data, right? And some will also collect in the future environmental data as well. So you have telematic devices looking at your driving patterns, wearables capturing, behavioral patterns, whether you eat well, whether you sleep well. Agricultural sensors as well to inform risk evaluation and proactive loss prevention. So insurance is moving from, being reactive to becoming proactive. So prevent and predict is a big part as to where the business model is going, where insurers want to become the partner of the customer, right? So we've seen, a lot of different programs. I remember in 2000, I worked on the Aviva telematics program at the time. There was too much data and we could not do anything with it. Now it's a different, completely different world. Progressive snapshot, for example, smart home sensors detect leaks and smoke and crop monitors. So the benefit, is about real-time data collection, improve operational efficiencies because you can actually optimize where your people are, as much as your adjusters, as much as, independent agents you may actually have on the field helping you with the claims processing, but also give you the opportunity for new business, right, at the same time. Now, when you start looking at that AI consumed data, right, because now we have all the data combined with the IoT devices, and then external feeds, because what you find is insurers have a lot of data. Insurance has so much data. But often today, when you start looking at the emerging risk, insurance do not always have the right data. So they are going to need external feeds, external data sources. They will need to make sure that data is cleansed, it's enriched using machine learning, right, and advanced artificial intelligence so that they can predict the risk and automate the decision so that they can actually serve the customer better and provide the alert when they need to be. That will be foundational for effective artificial modeling. Then you can add the more, now when we start talking about emerging technology, then you add to the cloud, and then can add blockchain and then quantum computing. We go into another sphere of technology announcement and where the industry could be when it actually starts really leveraging technology to serve themselves and to serve the customer in a better way. The Amazon way or the Netflix way, God knows.
So ideally, if you're an insurance carrier, you want to make your process of doing business as easy as it is to book travel, let's say, or 100%. Shop online.
100%. You want to make that experience, and I'm fortunate enough, I spend a lot of time moderating, facilitating conferences for a number of the big insurance conference providers. And the reason why I do that is it allows me to meet amazing executives, but also understand what is happening in their minds. And the main topic we talked about this year has been using technology to improve the customer experience. This number one topic this year. Challenged, we have legacy modernization in play. So how do we drive customer experience engagement with a legacy modernization massive project taking place? I'm sure you saw Guidewire's results. Guidewire took advantage of those legacy modernization this year. But what does it mean? It actually means that the operation of the insurance company needs to be completely reinvented. AI, the old processes will not work in the same way in the future. And so another things that come out from this conversation is how do we drive trust and transparency with our customers. So once we are doing all this modernization and we understand the customer wants experience, engagement at Amazon, Netflix, at the same time we need to make sure we keep that human in the loop to actually drive that trust and then transparency to actually ensure we don't churn those customers who actually are scared of technology advancements.
This is kind of pertaining to the market, financial markets surrounding AI companies. Some people are calling the valuations of AI companies a bit of a bubble because of the lofty share prices. There's a war for talent among programmers. There's costly build-outs of these data centers. What could be the fallout if there is, let's say, the bubble bursting? Like, we had the dot-com bubble more than 20 years ago, how a lot of these companies were driven up to ridiculous valuations, but no real profitable plans. How do you see this shaking out as far as if there is a bubble that bursts, and what could be the ramifications for the insurers?
Yeah, I remember 2021, and because I do analyze, the Insurtech space, I was looking at the numbers. 2021 was one of those years, I think 10 billion was investing in Insurtech, which was never seen. Last year was around 5 billion. I looked at the number before our conversation. This year we are around 6 billion, and I think we are probably going to finish the year at 7 to 8 billion investment into Insurtech. So I think what we've just seen actually is while there is investment coming into Insurtech, really the investment is going into companies which has done very well already. Think about underwriting and claims. So I would say the scale-ups, what I call the growth ventures, which have already proven their business model. But really the investment is going into AI Insurtechs right now. So your comment around, do we have a bubble and what do we do if there is a bubble is a valid one. The key thing is actually insurers, because we are in a risk-averse industry, tend to be really cautious in what they do. What I do see, though, is a lot of insurers observing, what is going on, and you can see this with the behavior of insurers where they actually announce a partnership or announce a small investment into a startup. I think what you need to observe is whether the strategy will be an acquisition strategy, right? Because often when insurers are doing a bit of investment, they are looking long-term as to whether they will want to acquire the company in the future. Yet, I think a valuation correction may create opportunities, though. I think I saw in one of your questions the dark fiber after the dot-com burst.
Oh,
right?
Absolutely. There could be a bunch of cheap assets available if there are a couple of high-profile failures, because there are bound to be at least a couple high-profile failures in this mix.
Absolutely. And so you may actually find that some corporates are looking for that scenario, to look at cheaper assets, lower cost, to enable them to acquire those, I would say, those teams, not just the asset, but often they also acquire the people. We have a talent gap in the industry. So it's a great way to also acquire the people, the talent needed to actually help the company move forward. So it could be interesting to see what happens, right? Insurance company already use some level of scenario analysis and capital planning. So I guess with good discipline, they can actually see what happened with their AI investment. And by really looking at ROI, flexible models, they may actually be not that bad position, regardless of what happened if the bubble burst.
Yeah, and I think with some of these people, if they've been burned in the aftermath of a bubble bursting, sometimes they look for a safe place to work,
100%. Absolutely a safe place, and safe but also stable.
Stable
place. Well, to work into. So absolutely true.
Sabine, do you have any parting comments as we wrap up the chat?
Well, I think, we are, and I'm sure you've read this everywhere, every report I think we read is around resilience. Resilience is the new growth agenda, I think, in our industry. And for me, insurers must pair venture, client discipline, right? How are they actually going to grow their business, not just by building things internally, but by looking for ventures which are out there, which have already built stuff, so that they can actually start building some level of discipline around societal and emotional risk insight, because they will not be able to do everything in-house. They must use artificial intelligence to prevent losses, right? We are talking about a lot of prevent and predict stuff, but actually right now we need to look more closely at climate sensors, climate resilience, cyber risk, right? Early warnings become super important to support communities. I think we need to remember, as you told earlier, that we are human and we have elderly parents who are not tech savvy. So finding a way to implement ethical governance and transparency in the way we use artificial intelligence will be really important. So, for example, I was talking to an insurer the other day, and I've seen a lot of tech startups do that, is that if you are talking to a bot, they will say, oh, I'm Emma, I'm a bot. You can click anywhere if you want to talk to a human person, right? So you have this awareness that if you want to solve something quickly, you can, but if you're uncomfortable, you can hop into talking to a real person. So we just need to have that dichotomy, that hybrid business model to fulfill the need of the digital savvy, but also the fact that insurance, a lot of elderly customers. And I would like to address myself to the Chief Digital Officer, because those guys have a lot of work to do, right? Whether it's the CIO or the CTO. It's important for them to continuously evaluate their top priorities, the top 3 priorities, talk to the board, but also make sure that the boards understand the transformation coming to us. It's overwhelming, but if you chunk it a little bit like Lego blocks, you will actually see the end of the tunnel, because not doing everything in a house is key, and really identifying those ventures which are going to stay for the long term will help them build the differentiation, uniqueness, and competitive advantage.
Thank you for listening to AM Best Audio. I'm William Borden.
Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.